Welcome, everyone. Welcome to the American Enterprise Institute. We are here to talk today about the European Union's road to recovery. And for that, I am joined from Brussels by Dr. Reinhard Felke. He is the Director for Policy Coordination and Communication at the European Commission's Director General for Economic and Financial Affairs. He's been in that position since mid last year. At the Director General, Dr. Felke's responsibilities span the European Commission's economic forecasts, economic surveillance of the euro area, as well as in the context of the European semester, implementation aspects of the new recovery and resilience facility, as well as internal and external communication related to the activities of the Directorate General. We'll be talking today about two broad topic areas. One is the European economic outlook, and the other one is the European Union's recovery and resilience facility, which is, of course, meant to be a major instrument in the European Union's economic recovery. And so we're going to talk first about the outlook, and then we'll talk to the recovery facility. Throughout the webinar, feel free to submit questions. You'll find instructions on how to do that on the webpage. Basically, you can use Twitter and email to send us your questions. And if your questions are good enough, I will incorporate some of them into our conversation. With that, I will ask Reinhard to take it away. I believe you have a couple of slides first about the economic outlook. We'll hear your presentation, and then we'll talk about it before, in the second half of the webinar, turning to the active recovery policy. And so with that, please go ahead and let's cue up the first slide. Thank you.
So hello, Stan. Hello, everybody. Many thanks for having me with you today. Let me kick off our conversation with a brief look at the economic outlook. We published our winter interim forecast last week. So I would present you with the main messages in a nutshell. So when we can move to the first slide. Yeah, thanks. So the pandemic is holding the European economy in a tight grip. And the euro area has slid back into recession in the final quarter of last year and the first quarter of this year. But the breakthrough of vaccines and the beginning rollout of mass vaccinations are a real game changer to the outlook. So when we're looking ahead, the quarterly prospect for the moment looks still pretty grim. So we have a mild decrease of growth, both towards the end of last year and in the first quarter of this year. Looking ahead, our assumption here is really much based on where we think that the vaccination will happen. So our baseline assumption assumes that towards the end of Q2, a critical portion of the most vulnerable parts of population will benefit from vaccines. And going into the third quarter, about 70% of the adult population should be vaccinated. And that should allow to, gradually towards the end of the second quarter, and then more and more decisively in the third quarter, to ease and lift containment measures, which are very tight at the moment. That would then bring our forecast in terms of quarterly profiles somewhat up already in Q2, but then much more decisively as of the third quarter. In terms of real GDP for the year as a whole, we expect then 3.8 for this year, and for the 2022. I see here is a little error in my slides, and for the euro area, and 3.5 and 3.9 for the EU. Now, the recovery is set to be uneven across countries, while the EU as a whole is expected to reach pre-pandemic output levels by mid-2022. There are a number of countries that will be slower, and including Italy and Spain, where we see the pre-pandemic levels being reached only after our forecast horizon after 2022. What's important to note is also that none of the countries will reach in 2022 the level of output that we had projected in our last forecast before the crisis. So there is an important gap that remains. The second slide I wanted to show you refers to the risks. I mean, the situation in which we have conducted our forecast remains, particularly uncertain, and risks remain very important. It's fair to say that some of the risks that we had identified in our previous forecast in autumn last year have, luckily dissipated to the largest extent. In our autumn forecast, we had in our baseline assumption assumed that there might be no deal on future free trade agreement between the EU and the UK. So that materialized just on Christmas Eve, basically. And we are also now much more constructive concerning the trade policy going forward. Here in Europe, the major downside risks that we see is of course that we are witnessing a bit of a competition, a race between the new, much more contagious variants of COVID-19 and the rollout of vaccinations. So here, well, I mean, there's a risk that the infection rates will not come down as quickly as hoped by governments, and that containment measures need to be remained in place longer. That in turn could also have, if the containment measures remain in place for longer, the scarring impact on the economy in terms of insolvency rates, but also raises in unemployment and risks of longer-term unemployment, hysteresis risks would loom larger than what we have depicted in our forecast. And finally, we see in our forecast horizon already a divergence across member states. Now, if that were to deepen and to prolong more systematically, that would also hold back the momentum for the euro area to recover momentum in the course of the year. Now, but not all is dull and dark. I mean, there are also a number of important upside risks. I mean, one, all capacities in Europe are basically scrambling now to ramp up the capacity for production of vaccinations and the supply, so that maybe or could be rolled out faster than we had anticipated it in our forecast. There is also there are a number of factors, and I'm happy to coming back to that in the conversation, which provide arguments for a faster and more forceful rebound of the economy. I mean, I'm just mentioning that private savings, household saving, is at a historical high. Financing conditions are very supportive, and that links me to the last point here that I wanted to make. And we're also putting in place in Europe the important collective European support instrument with the abbreviation of NGEU, stands for the New Generation EU, so a big budget instrument to support the recovery. The RRF stands for Recovery and Resilience Facility, which we have not factored in, or only to a very minor detail factored into our economic outlook of the forecast. Now, with that, I would stop here, and I'm looking forward to our conversation.
Thank you very much, Reinhard. And I think that's a great overview of the of your forecast and of both the downside and the upside risks. There's a number of questions I have related to the outlook and to policy as it's been implemented and continues to be implemented. One thing I wanted to pick up on first is you talked about the uneven recovery across various states. Of course, here in the U.S., we've also seen different states are hit differentially from others. There are states here in the U.S. that are very heavily reliant on tourism, for example, that have struggled more than others. Can you talk a bit about why Italy and Spain in particular are struggling? How you think policymakers can address that, and also just what the sort of medium-term risks are of that kind of divergence that you highlighted on your slide.
Yeah, thanks, Stan. I think there are basically two factors that explain to a large extent the differences across countries. The first one is the dynamics of the pandemic and related to that, the containment measures. And here we have seen a bit of a cycle. I mean, Italy has been has been the first country most hardest hit by the pandemic last year, and had therefore also to maintain very deep and intensive containment measures for a longer period than it was the case in a number of other countries. That explains one thing, and that to some extent a little bit with a décalage, so some time lag, explains it also for Portugal. The second aspect is the structural composition of the economies. In both economies, and here, I mean, we could add also some of the others, Croatia or other countries, where Portugal, for instance, where the tourism sector plays a relatively important role, and other contact-intensive sectors like hospitality, services, which is a sector that is, by definition, most affected by the containment measures that affect face-to-face services. And therefore, I mean, the tourism season last year has been terrible, and that explains to a large effect the situation that we see there. Let me add for Italy is of course that the overall growth momentum in Italy remained relatively subdued also pre-crisis. So here we also have an issue that the economy started from a softer patch when the crisis struck.
And so now some of the countries you mentioned, of course, now would include Greece in that category too. They also, I think, struggled after the global financial crisis throughout the Great Recession, and posed macro risks sort of to the entire European economy. Is that a concern you have going forward, that we end up in the same situation where interest rates start going up in some of the countries that are now hit the hardest because of their relatively heavy reliance on the tourism sector, and because they were hit hardest at first? Is that a concern, you think, for the European economic outlook?
Stan, I think this was a concern at the beginning of the shock, to be honest. I mean, in February, March last year, when we were starting to fully understand the magnitude of what was hitting us, that was a real concern. But what became very quickly clear was that, and this is also a political dimension, that the nature of the shock is a completely different one. And the fact that this was something that hit everybody out of the blue like a natural catastrophe changed completely the political dynamics inside the EU. There was very quickly a very strong and firm consensus about what the right fiscal policy response should be, for instance. The European Central Bank acted also, very, very fast and quickly. We, on the Commission side, we activated what's called the General Escape Clause, so that the fiscal rules that apply to member states are in a way suspended to allow member states to let their automatic stabilizers to function fully.
And yeah, so to clarify for our viewers, normally member states of the European Union are supposed to run relatively small budget deficits, right? Say, roughly speaking, at most 3%. It depends. The rules are a little more subtle than that. You can compare that in a sense to the situation in many of the states of the United States, right? Which all but one have a balanced budget requirement, and so they which are not suspended. To be clear, they're often constitutionally bound not to run budget deficits, and so they have to rely on the federal government for support. In the EU context, those rules exist, but they have currently basically been waived, and for the foreseeable future. Is that fair to say?
Well, the foreseeable future, I mean, right. It's, I mean, what's clear, the consensus is also very clear for 2021. In a context where we remain, I mean, first of all, still, grappling with the pandemic and the fallout of that, and the enormous uncertainty. Now there is some discussion about 2022, but that at the moment still looks quite a stretch away. So what's clear is that there is a very firm consensus across EU member states to keep the fiscal support, but also the policy mix supportive as long as this emergency pertains, and as long as containment measures are having an impact on corporates and on employment.
And so that policy mix consists, you read roughly, obviously there's a monetary / central bank component, and there's a fiscal component. So the fiscal component we'll talk about in the second half of the webinar, but on the central bank side, the European Central Bank has been very aggressive from the beginning of the crisis, just like the Fed has been. And so you're saying basically that combination of actions, and also I would say pretty remarkable political developments with the recovery fund. Do you think that those have basically managed to keep those macro risks from divergence under control?
Yeah.
Well, that is good. So then the other item you mentioned is sorry, go ahead. Yeah.
No, I mean, just to say, I mean, we have not seen the type of fragmentation of financial markets that we had seen 10 years ago at the onset of the financial crisis. So, the differentiation of risk premia is very low, and I think this is largely owed, as you said, to the big resolve and the collective action at the EU. So we're this time, acting fast, and we're acting in the right direction, and we're acting together, and this is showing results.
Excellent. So on you mentioned scarring, right? And so we can think of that in two ways. One is, which I think you mentioned, the sort of at the micro level, workers are laid off. They aren't employed for a year or so. They struggle to return to work as the recovery commences, and so they lose their firm-specific human capital. They lose some general human capital that has long-term consequences. Of course, on the business side, you could potentially see the same thing, right? Unnecessary bankruptcy, some organizational capital gets destroyed, etc. And so I don't know to what extent how would you think of the level to which member states have taken action to keep those two things from happening versus the European Union and the more union-wide policies? Can you talk a little bit about the different types of programs? So here in the US, I think really for the first time, there was a big program of business support through the Paycheck Protection Program, which to me felt very European, right, in spirit, in the maintaining employment by directly supporting businesses. Can you talk a little bit about those efforts, both at the national level, at the European level, but in particular also how those different lines of effort are coordinated?
Yeah, Well, perhaps first a general remark. I mean, in the European member states are characterized by fairly big and I mean, compared with the US, fairly big social security systems. So automatic stabilizers are kicking in case of an economic downturn quite importantly, and they absorb a lot of the overall shock. But given the nature of the current shock, this clearly has not been sufficient. And first, on the labor market, all the member states ramped up significantly their short-term unemployment support measures. And here is actually an important interplay between national member states and the EU. So for the first time and very quickly in spring this year, so last year, the EU set up a 100 billion support scheme that provided cheap loans to member states to actually put in place such short-term unemployment schemes, which had not such instruments before that. And the take-up of that was very important, and that's another element that helps avoiding the fragmentation that we had seen 10 years ago. So there's a good combination on that, and that has basically helped to reduce the outfall of unemployment quite significantly.
So how was that, Reinhard? How was that credit facility funded? How was that financed?
This is also financed. I mean, this is another totally new and innovative territory Europe has entered by going to the market and financing this by taking up financing from the capital markets. So there is a direct back-to-back loan financing for the Commission, which is also for the new generation EU. The essential new instrument that this is debt financed collectively. But the other aspect that I wanted to mention, of course, is the business sector. And here there was right from the beginning, a very clear view that we need to avoid the scarring and to avoid that solvent companies are falling into liquidity problems in the course of this crisis. So member states, again, provided direct liquidity support, but also a lot of guarantees to help them access financing. And thirdly, and that is something I think we need to reckon for going forward, many member states also introduced outright moratoria for their insolvency procedures. So which comes to the kind of counterintuitive result that in the crisis year of 2020, we see in terms of overall numbers less insolvencies than in previous years. Now that is something that certainly is going to change looking ahead once these emergency measures are being wind down. But for the time being, they help to stabilize significantly, and should also help to minimize the scarring effects of all of that. And the last word, if you allow me, because there's also an important interaction of action at the EU level and the member state level. In the context of the European single market, we have also clear competition rules which set limits to what extent state aid support can be provided to national companies. And we have, from the European side, very rapidly provided maximum flexibility to allow member states to flexibly react to the needs.
I see. And so on the insolvency issue, are you worried that that basically what we're seeing is a sort of pent up demand for bankruptcies, and that as support measures are withdrawn, and really just as we go into the recovery, we will suddenly see a lot of firms go under? Because there will be some debt overhang. There will be companies that just hadn't really have to adjust because they were enjoying some level of revenue replacement. Can you talk about that a little bit?
Well, I mean, to me, this is almost inevitable. As I said, the number of insolvencies in 2020 went down compared to average years before that. So once the moratoria and emergency measures are phased out, we should almost statistically normally see an increase in solvency. And that, of course, is compounded by a situation where we now have a relatively long period for of containment, which for some companies in some sectors mean zero revenues, while basic costs remain in place. So to me, this is fairly clear. We don't have, and we cannot have, an exact quantification of this. What's also clear that there are important sectoral differences. So I mean, if you look at the same story, I mean, if you look at the sectors that are most affected by the containment measures, then you're talking about contact intensive services. I would expect that in tourism sector and hospitality, we probably see more insolvencies going forward. There's also an issue about the size of the structure of these sectors, which are frequently characterized by smaller, medium-sized enterprises, sometimes family-owned, where the access to financing and alternative financing will be more difficult. But of course, all that is a function of how long this containment situation will continue. And again, I mean, coming back to our forecast, if our constructive baseline assumption comes true, then we should be seeing the end of this trough, going into the second quarter, and that should also help limit the damage here.
For sure. So these different scarring elements that you may. So I think the way, and this is going to sound like I'm mocking macroeconomists, but I think the way some macroeconomists think about scarring is you have a trend line, and if you fall below it and you stay below, you don't go back to trend, that's scarring, right? And so you talked about returning to the 2019 Q4 level, but it wasn't clear to me from the outlook whether your sense is that the European economy will return to trend anytime soon. Do you think that's feasible? Do you think that should be the objective? How do you think about that?
Well, I mean, first of all, for the forecast horizon, so this year and next year, our growth is significantly above trend growth in Europe. So there is a significant catching up that is taking place. Well, I mean, so far we haven't looked beyond 2023. What's also very clear, calibrating potential growth right now is a very difficult exercise. And I wouldn't like to put the cursor too much to an exact number at this stage. But what's clear with the growth outlook of just below 4% for 2 years, we're significantly above potential growth, and so there is catching up taking place. At the same time, I mean, what's important also to keep in mind, I spoke earlier about the reaching the levels of output pre-pandemic. If one projects the forecast of our last forecast before the crisis, I mean, by the end of the forecast horizon, we would still be 4% below that. So the gap remains. Now, I mean, an important aspect that relates to this macro scarring is what we're currently also discussing in the context of this recovery and resilience plans. I mean, what's the trade-off between more short-term recovery support and more long-term support to the transition of the economies, also to address and manage the transition to a more climate-friendly and digitalized economy.
And let's save that for the second half of our conversation. Okay. But we're almost there. I have 2 audience questions I want to ask before we turn to the recovery and resilience facility. The first one is, What would you say about the importance of migration, sort of within the European Union, in the recovery, and how the EU will, it says, reestablish free movement here? How do you, what is the, so one way of thinking about these regional imbalances is, people will move from places with high unemployment to places with low unemployment, right? Which is the Blanchard-Katz view of things. Is that something that the Commission accounts for, thinks about? What would you say about that?
No, thanks. I mean, what we have seen and witnessed during the financial crisis was indeed a significant increase in the kind of labor mobility that you're describing, no? And compared to let's say 2 decades ago, that mobility has significantly increased across countries. Does it provide for a meaningful, macroeconomically relevant stabilization? I would say no. I think one really has to take into account the European context here. I mean, languages, differences of cultures. Even though we're making progress on the on accepting educational degrees and all that, it still provides barriers. So when you compare that to the intra-US mobility, I mean, where Europe is far away from that. And also when you look at the educational attainment of those who are most mobile, then you have, as a rule, the higher educated who are moving and are much more mobile across countries, which is also, I mean, in terms of the most affected in terms of economic shocks are those that are less affected. And so yes, there is progress, but not to substitute for other stabilization measures.
Here in the US, we're trying to use housing policy to make it impossible for anyone to move, and so that way US mobility rates will converge to European rates as well. So I have a second question from the audience, and the question is: how do you view the prospects for a revision of the complex EU fiscal rules?
That's a good one. Thanks a lot for this question. I mean, let me start by, right now, there is a firm consensus to keep fiscal support in place to the extent that this is needed, and as long as containment measures are there, and that is hugely important. We, from the Commission side, we launched a review of the existing fiscal framework at the beginning, I think more or less exactly a year ago, with a communication. So that was pre-pandemic. And we wanted to use that basically as a kickoff to use 2020 for a broad consultation about what needs to change. I mean, I don't want to go through all the details of that, but making the rules also simpler is one of the key objectives of this. Now, to be quite honest, in order to have that debate in Europe, I think we need the right level of political attention to this. With governments grappling with an unprecedented pandemic in their places, with the EU and member states trying to put on the ground now this recovery and resilience plans, I do not think that this year is the right time, or that we will get this necessary attention to bring this debate, more conceptual debate, really forward. This having said, to me, there is a question, about when to exit from this general escape clause, which basically waives the rules when we exit from this, and shouldn't we not then also transit into a new framework? So there is an issue. I mean, how to articulate these processes, and I mean, but there is it's not a Commission official view, But my view is that that indeed towards the end of this year, I think we should be launching this debate in earnest to make progress. And maybe a last word. I mean, there are a number of elements that I think are coming out of the experience with the current pandemic that we have to factor into this debate. And one element clearly is the unprecedented sense of solidarity that we're seeing right now, in the sense that we're all sitting in the same boat in the EU. I think this is something that one also firmly has to take into this debate on future rules.
Yeah, I must say I'm from the Netherlands. Where obviously these budget rules have long been a very sensitive topic, and I've been surprised over the past year by how relatively easily certainly the public went along with the changes that were made, both the waivers and the composition of the recovery facility, which is the topic we're going to talk about now. And so you have a few slides on this as well, and so I will let you give people an overview of the facility and Next Gen EU, and then we can go back to our conversation.
Yeah, thanks a lot. We can move to the next slide, actually. So let me say a few words about what it is and how it will work, and then we can go into more detail in the conversation. So the Next Generation EU is an unprecedented plan proposed by the Commission immediately after the outbreak of the crisis, and was also rapidly approved then by the European Council in July. It provides large-scale fiscal support to member states to finance investments, but also reforms with the aim to help Europe to recover from the economic and social damage of the crisis, and to make the economies more sustainable, resilient, and better prepared for the future. The facility was designed to counteract the widening economic and social divergences between member states, and this means that the allocation of money to member states is reflecting the different impact of the pandemic and on their economic structures. So, in other words, those countries being most severely impacted by the crisis and with the weakest starting positions are benefiting the most compared to the stronger ones. Overall, the RRF will provide a total of some 675 billion euros, and the support will take the form of grants of more than 300 billion euros, and the remaining 360 billion euros in form of loans that are for quite a number of EU member states, significantly cheaper than what they could be financing by themselves. It's important to highlight that the facility is not a short-term instrument for recovery. A huge amount of the resources will be devoted to modernization of the European economy. And for this reason, the main objective of the RRF is to finance also reforms and public investment that will foster the green and digital transitions, and addressing also key challenges that are identified in member states. An important principle is really the ownership. So it's these, and then we can move also to the second slide here. That's the key operating principle. So it's member states' money, and they are designing the plans. But in order to access financial support, member states need to prepare recovery and resilience plans, and in which their reform intentions and investment intentions are being detailed. And member states are strongly encouraged to focus on areas that deliver tangible benefits to citizens across the EU. As I said, an important element of these plans need to demonstrate that they support the transition towards a more climate neutral economy, and also make progress towards the digital transition. where do we stand right now is all the member states, and we are in the Commission are now in close dialogue and constructive dialogues with member states about the design of these plans. The common objective is that we will receive the plans from the member states by the end of April. The Commission then has the job to assess these plans and to prepare a decision for the Council to approve them. So it's a co-decision. It's not like that there is a Brussels-based bureaucracy alone deciding on that, but it's actually going to the finance ministers as well, who take a look at what we are assessing. Now, if the approval of these plans is positive, that will trigger a pre-financing more or less instantaneously, which is substantial, of 13% of the envelope of the grants. So that's something that would be paid upfront. So a direct short-term recovery boost. In subsequent disbursements will be based on twice a year on so-called payment requests, depending on the progress on the implementation of the intentional or of the planned investments and reforms. I will not go through the timeline here in detail. I think that's a little bit too much. But maybe just to conclude on this, this is indeed, I mean, an unprecedented instrument and signal of solidarity in Europe. And we briefly touched upon that, Stan. The financing of that will be done by incurring debt. So that is also, has been very long a red line in Europe. It is backed up by the EU budget, and I think this is one of the reasons why also the overall market reactions to this has been very positive. Now, what's clear to me, and that will be my last word for introduction. What counts now is that the implementation of these plans, I mean, the level of ambition is really up to the challenges. And here, the feedback that we're getting also from the national debates is that governments, but also the wider discourse in member states, is really one that appreciates the unique opportunity that this instrument provides for making a leap forward in putting reforms in place that are sometimes overdue for quite some time. It also provides an instrument to reconcile responsible medium-term fiscal policies with the necessary ramping up of public investment going forward. So I will stop here, Stan, and happy to continue our conversation.
Excellent, thank you, Reinhard. I think that was a great overview. And so while I think it's good that we didn't go into the timeline as sketched out there, we did immediately get a question about the timeline. And so Joshua Lieverstro asks, the predicted overall EU GDP from the forecast will return above Q4 2019 levels by the end of 2022. Yeah. Will peak RRF spending come before that or after? And so it's basically about whether the recovery spending will occur prior to return to the pre-crisis levels or
no, thanks a lot. Well, two parts of the response on this. I mean, first of all, our forecast right now, what I presented, does not include the recovery funding. Now, in terms of the timing of the whole business now, we expect member states to submit their plans by end of April. And I think the bulk of the member states is likely to be there. Then there is indeed, together the Commission and the Council have about 3 months to assess the whole thing and to decide it. So in the baseline, we should see first disbursements starting in July this year, but probably the bulk only in the second half of this year. And then there will be disbursements, depending on the progress on the implementation of the plan, twice a year, over an overall horizon of 5 years, so until 2026. And the peak of disbursements will be country specific at the end of the day. It's not predefined at this stage. But of course, the pre-financing is supposed to give an important boost. And that is something, I mean, in terms of economic impact, I think one should see it particularly towards the end of 2021, but going more strongly forward. And let me stress again, I mean, this is not direct support to households or anything. I mean, this is funding to a large extent really to modify and modernize the supply side conditions of the economy. So it's more of a structural instrument than a short-term stimulus instrument. I don't hear you. Sorry, I think you're muted, Stan.
Yeah, no, I always have. I'm actually kind of surprised I managed to avoid it till now. So I have a few other questions about the way that the facility is organized, but let's talk about that aspect. So the fact that it's organized, that it's focused on sort of structural supply side conditions, and you highlighted the green transition, digital transition. Now, those are not, I think, typically terms that people in the US use, and so it may be helpful if you give examples of what kind of policies, what kind of projects should we think of. I have been, but here in the US, it'd be very controversial if those kinds of conditions were attached to federal funding for state and local governments, right? It would be hard to imagine that the government of Alabama would be happy having to spend a third of federal support money on the green transition, right? And you know, and I won't name them, but I can think of some European governments where I'm also surprised that they'd be happy to go along with that. So can you talk about how that works? What kind of projects we should think of? What leeway member states have to choose projects?
Yeah, I think it's important to keep in mind. I guess, I mean, what we've done here is mobilizing taxpayers' money, even though future generations' taxpayers' money across the EU to invest and support EU member states across the board. So I think there is a legitimate right to say, well, we need to put some key objectives and criteria in place to make sure they are invested in a way that benefits us all. So the overall European public good is an overriding objective of this. It's not written as such. I mean, these legislations at the end are never written by economists, but this is the overarching objective of the whole business. And now, to give you examples, very concretely, I mean, we see in the emerging plans quite a bit of investment to modernize the energy sector. To ramp up the use of renewables. We have also in the EU a common objective to move to a climate neutral economy by 2050. So this is an instrument that is also at the beginning of this transition, and for member states to employ. And we actually see, I mean, I was asked similar questions before. I mean, the objectives tie in very much to the domestic debates. I mean, if you look at what are the big topics that drove the European elections a year and a half ago, I mean, they were along that line. So we're meeting pretty much preferences of citizens across the EU. In concrete terms, in addition, I mean, it's also a renovation wave in countries that could be financed. Of course, some regions, for instance, I mean, I'm thinking of concretely of Poland, but also other places where carbon continues to be an important part of the industrial output. I mean, there, this instrument is further reinvigorating domestic debates about where they want to go with their economies and their energy mix in the future. But this is something that we would have had in any case. And I must say, I feel heartened by the discussions that we see, that people in the most affected regions there, they actually, project themselves ahead. I mean, they're asking their question. I mean, where do we want to be in 10 years' time with the economy of our region? And the old coal mines are not the future for our children. So here we're having quite a constructive discussions in the member states going on.
I did a webinar with a Spanish official a couple of weeks ago, and he, in fact, so I asked him about this, right? How do you think about these restrictions? And he in fact said exactly what you're saying, which is, it's perfectly in line with our pre-existing priorities, so it works out fine. But I was just wondering how that had played out across the union. So back to the financing. So you say, right, so debt is issued. How is that debt paid back? Is that through the EU's regular revenue streams? Is it in the multi-year budgets? How does that work? Okay,
the period for repayment of that debt is from 2027 on until 2058. So it's a relatively long time period.
And it doesn't start until the next budget.
That's right. Yeah,
I see.
So and indeed, I mean, the budget needs to make provisions. At the same time, the legislative initiative also foresees that the Commission will come forward with proposals to strengthen the EU's own resources. So there is a bunch of options are under discussions. I mean, the proposal is not yet there and is not yet solidified. Elements under discussion are, emission trading system, which could be an element. There is discussions underway on the solidifying the corporate tax base in Europe. There is a long-standing discussion about a financial transaction tax. There is the possibility of a digital levy, which gains some traction in political discourse, because digital companies are among those who are benefiting the most of in the crisis. Carbon border adjustment mechanisms is a potential here. So that is something that is coming forward.
I would refer interested viewers to an event I did, I think 2 years ago, with Commissioner Moscovici on the digital service tax, followed by a panel. You can find it online. It was an in-person event. It's really weird to think that seems to be a possibility. So I see. So that makes total sense. Then the second thing, you mentioned it briefly in your presentation, is that money will be allocated in part based on need. And so this has been obviously it's an issue here in the US too. So far, state and local funds have mostly been allocated just based on population numbers, with a fixed number for each state. The Democrats who now control Congress and the White House, in their proposed rescue plan, as they call it, funding is more tied to unemployment rates. And obviously that's controversial, because some of those unemployment rates are higher in blue states, but then there's some other elements. It's a little less transparent than just tying to population numbers. So what are the criteria for the RRF funding, and how is the impact, or the need, how is that calculated? How do you think about that? Because to some, these things you can game them to some extent, and so how has that been put together?
So it's basically two indicators that we're looking at. One is indeed the GDP per capita. So that's one element. And
I see, but so that is not crisis related. That is simply that's it. Yeah.
Exactly. So there is a structural element that basically says, okay, one determinant is simply the poorer member states are getting higher support, and the second one is the relative impact of the economy. So we looked at the economic downturn, and we will revisit this formula also. Well, not the formula, but the data midways in the rollout of the program. So by 2022, we will take another look at how the economies have evolved, and the final element of the envelope will then reattribute it according to this updated allocation key. I mean, it's a complicated formula which I cannot recall now in detail, but it's these two factors that basically drive the allocation. And as you can imagine, I mean, there has been during the legislative process quite a bit of discussion around this. But as I said, I mean, this is part of the solidarity dimension that I mentioned. There has been a relatively quick agreement that would make sense. So countries like Luxembourg with the highest GDP per capita get a very tiny portion. Countries like Croatia or Bulgaria get a significantly higher portion. And also countries like Italy and Spain or Portugal, who have been very hard hit by the pandemic, get a higher portion.
I see. Okay. And then I think we have about 4 minutes left here. And so I think I will close out with a question that you surely expected. Fortunately, one of our audience members posed the question. It is, how do you view the prospects for a revision? How do you view the prospects for a permanent central fiscal capacity in the European Union? Now, of course, we talked about this a little bit already, right? Because obviously, once you have debt in place that's going to be in place for 30 years, you need, additional fiscal capacity at that level. But it is, right, a move to new instruments for own resources, I think, is a pretty dramatic one, and so I think it'd be good if you gave us your thoughts about that.
Well, I got a similar question a while ago, whether this was really the Hamilton moment for the European Union, and I responded, and I will respond the same way now. I mean, for me, this is more of a New Deal kind of instrument, and I think what's our duty now collectively in Europe and in the member states is to make it work. And if we manage that, by mobilizing this collective support instruments, if we manage to get a proper, coordinated, meaningful reform agendas in place across countries that have an impact, I think then we're demonstrating and making a strong case for however you want to call it, but for a more federalist structures, at least to some extent. It has been born out of an emergency, but I think if we can demonstrate to make it work, then we're moving into a new ballpark.
Interesting. And speaking of ballparks, the size of the fund is very large, right? So yes. I'm not sure everyone realizes this, but normally the EU budget is about 1% of EU GDP, and the facility is a multiple of that. Yes. And so it really is a dramatic expansion. So I see the comparison with the New Deal is an interesting one. I hadn't thought about it that way. Well, I think that is all for today. I want to be respectful with everyone's time. Thank you very much. I think we covered a tremendous amount of ground here, and so I thank you for that. I think both the audience and I have been enlightened. And thank you all for tuning in.
Thanks a lot for having me.